Hello everyone, my name is Anjali Kumar Khetan. I am based out of Bangalore and is working as the regional head finance for a US MNC. I am also a visiting faculty in ICAI for many years when it comes to Ind AS and IFRS, and also an identified faculty for GST under ICAI's umbrella. Now in this particular video, we will look at another interesting topic which relates to what is the point in time when an entity needs to derecognize a financial liability. The reason why we are talking about this particular topic because there has been a recent amendment wherein the accounting requirements have changed, though this particular topic seems to be intuitively very straightforward. So let us look at what are the key requirements when an entity needs to derecognize financial liabilities, the general principles in terms of when to derecognize. And as you would be aware, the expression when we say derecognition simply means what is the point in time when should a financial instrument, say for example, the creditors which an entity has, it needs to be removed from the balance sheet or the financial statement. So derecognition of a financial liability deals with a situation wherein an entity needs to determine what is the point in time when it needs to be eliminated from the balance sheet. Now, if you look at the generic requirement, paragraph 3.3 of IFRS 9 or Ind AS 109, it gives you a guidance that derecognition of financial liability, say for example, your trade creditors, should happen when the contractual obligation towards the financial liabilities cash flows have been extinguished. Paragraph 3.3.1 does talk about it. Now, when we say extinguishment of the cash flows related to the liability, that extinguishment can happen, say because the entity has discharged its obligation under the financial liabilities. Say for example, discharge may happen because the entity may pay cash to discharge its obligation, by issuing some goods or some other financial asset, or the cash flows related to the financial liability could have been cancelled or expired. Cancelled, that means the entity is legally released from its obligation, whereas the word expired means the expiry of the cash flows related to financial liabilities may happen, say, because of the passage of time. So this is the generic requirement which is there under IFRS 9 or Ind AS 109. So we will use this framework and we will see how the issue has arisen considering this generic requirement. We will see what the issue is and what is it that the standard setters have sought to address in the recent amendment. So by way of the background, as we have seen in the prior slide, the requirements of derecognition, on the face of it, it seems that it is very straightforward. So the timing of the recognition or derecognition seems relatively simple and straightforward because it is when you actually discharge your obligation. However, of late, there have been significant amount of debate which is happening on account of this particular topic wherein the preparers of the financial statement have been reaching out to the standard setters and asking specific guidance because there is a wide diversity in practice actually followed by various entities when it comes to the timing of the derecognition of financial liabilities. And more specifically, when such financial liabilities are settled using some kind of electronic payment systems. Now, today we know, for example, in India, when you want to make a payment to your vendor, say, for example, you use NEFT or RTGS, so that does not entail too much of the time. So the moment you initiate the payment, in some few minutes or max an hour's time, basically the payment gets through and your account gets debited and the recipient or the beneficiary's account gets credited. But this need not be the case, let's say, when you are transferring funds internationally. And we will see this by way of an actual situation in the next slide. So therefore, because of the fact that there is a wide diversity of in practice followed by the company in terms of the point in time when the derecognition is supposed to happen, and therefore there was a ask, in terms of getting a clarity from the standard setters, what is the point in time that an entity need to derecognize such financial liabilities. And therefore, the IASB, from an IFRS perspective, has issued amendments to IFRS 9 to provide specific guidance, and this is more as a clarification, to clarify that when a financial asset or a liability, so for example, we are in this video talking about financial liability, so when a financial liability is, what is the point in time that it needs to be recognized or derecognized. And similar amendments, of course, this amendment has come under the IFRS world. Similar amendments are expected to come under the Ind AS world as well, under Ind AS 109. Now, it is important to note that from an IFRS perspective, these amendments which have been brought in IFRS 9 is effective from annual period commencing 1st of January 2026. An early application of these amendments are permitted, thereby meaning as and when these standards are the amendments are brought into the Ind AS standard, it is likely that from financial year 26-27, these amendments are also expected to be effective from the Ind AS perspective as well. But we have to wait and see until the actual notification of these amendments happen, in the Indian context. But it is likely that similar amendments will come in the Ind AS world as well. So this is the background. And also the amendment says that, and that is something which you will see, that if certain criteria is met, then even after the amendment, which we are going to talk about, even after this, the entity which has made payment to the creditor may be permitted to derecognize financial liabilities which are settled by means of an electronic payment system at a point in time earlier than the actual settlement date. And we will deliberate on this also on the next slide. I will explain this pictorially, and then we will see what is the guidance available post the amendment. So let's see what, if you look at, let us say there is a supplier S which is based out of Finland, and that supplier has issued and supplied goods to an India-based buyer and raised an invoice of, let us say, $5,000. Right? So this buyer in India has a year-end date of 31st of March, let's say 2024, and therefore this is the reporting entity. Entity B is the reporting entity in my example. Now, consider a scenario that to settle this payment of $5,000 on 31st of March itself, which is the year-end date for the India entity, let us say a payment of $5,000 is requested or initiated by buyer B using his bank ICAI, for example, the Indian bank. Using that Indian bank, they initiate the payment of $5,000 for the supplier, which is based out of Finland. Now what happens? Payment is initiated by bank ICAI on the same day, which is 31st of March, and on that date, ICAI, the Indian bank, debit buyer B's bank account. Now what happens? Because it's an international payment, consider a scenario that though the payment is initiated by bank ICAI on 31st of March, assume that it takes few days, let us say 3 days, by when the recipient's bank, so bank FCO, which is the banker for this supplier, it credits the bank account of the supplier on 3rd of April. Why so? Because there is some time lag between the initiation of the payment and the day when the money gets credited in the supplier's bank account. Now, in the scenario which was deliberated by the standard setter, it is like this: that I, as an entity, using my bank account, I initiated the payment on 31st of March, and the payment eventually gets credited to the supplier's bank account on 3rd of April using an automated clearing system, and that automated clearing system takes, for example, 3 days of time to settle this transfer, which was initiated on 31st of March 2024. Now, the question which was raised, when it comes to the buyer B, what is the date on which the buyer B needs to eliminate the creditors from the books of account? Should they eliminate the creditors from their books of account on 31st of March 2024, which happens to be the year-end reporting date, or on 3rd of April when the actual realization is achieved by the supplier S? So the reason why these questions have been raised, one is because during this time from 31st of March till 3rd of May, effectively this supplier has not got the money. It is in transit. So the cash is in transit till 2nd of April 2024, and it is only on the 3rd of April that the actual payment is received by the foreign supplier. So this is the problem statement, and this question was raised to the standard setters, that what is the point in time when the entity B, which is the reporting entity, need to derecognize the creditors from its books, the financial liability. Okay, so that was the question. Now let us see the next slide, what this amendment to IFRS 9 now requires. So I've just put the problem statement of the previous slide, in a different pictorial diagram. So this is on T0, 31st of March, payment was initiated. The payment is actually completed on 3rd of April, and in between there is the amount, which is the cash is in remittance, is there in transit. So the actual payment is received by the vendor on 3rd of April. Now, when we are talking about the automated clearing system, assume that the moment this payment is initiated, assume that till this time, until the payment gets credited, it is assumed in this case that the payment which has already been initiated cannot be cancelled by the Indian company. Now, if that be the case, the amendment to IFRS 9 tells you that in general, the general requirement is, after the amendment, the requirement is that in general, the guidance is that the derecognition of the financial liability, the creditors in my example, the derecognition should be on the settlement date of 3rd of April, T3 in the chart above. That should be done on that day. Why? And we will see why aspect of this, because this logic has to do with the first slide which we saw, the generic requirement under IFRS 9 or Ind AS 109 in terms of the point in time when the financial liability needs to be derecognized. However, so the generic post-amendment, after the amendment, this is the general requirement. That means the entry or the derecognition should happen on 3rd of April. But there is an exception or exemption which is given after the amendment, and this is an optional exemption. But this exemption is subject to meeting certain conditions. What is that? So what the amended position says, that by way of exception, entities, that means the Indian company in my example, are however allowed by way of an exception to derecognize the trade payable before the settlement date of 3rd April 2024, potentially on the day they initiated the transfer, when that Indian company uses electronic payment system that meets all of the following 3 criteria. What are the 3 criteria? It is like this. So what the amendment tells you, that if these 3 conditions are collectively met, then by way of optional exemption, the Indian entity can still derecognize the the financial liability on the day of initiation, but only when all these three conditions are met, and that too, it is optional. So there is an accounting policy choice which the entity need to make post-amendment, that what they want to do, whether they want to do the settlement date accounting or they want to do the day when they actually initiate the payment. So what are the three conditions which need to be fulfilled? The three conditions which need to be fulfilled before an entity can apply this optional exemption are these three. That is, the Indian entity has no practical ability to withdraw, stop, or cancel the payment instruction of $5,000 in my case. Once the payment instruction goes out of the door, then the Indian entity has no practical ability to withdraw that instruction. First, then the Indian entity has no practical ability to access that $5,000 funds, which means funds are already debited to the bank account of the Indian company, and the Indian company cannot utilize that even 1 penny out of that 5,000 for any purpose, because payment is already debited and gone out of the bank account of the initiator. And the third, there is an insignificant settlement risk, because as we have seen, there is an automated settlement system in between the payer and the payee. In this case, the payee is in Finland, payer is in India, and there is an automated settlement system. So the third point says there is an insignificant settlement risk associated with this electronic payment system. Once all these three conditions are collectively met, that is the only situation in which an Indian entity, in my example, can potentially record can derecognize the financial liability, the creditors, on the day of the initiation of the transaction. Now, also, as I said, that this is a choice which the entity need to make. And this choice which they need to make is on a system-by-system basis. So, for example, if an Indian entity is using, let us say, 3 different payment systems for remitting funds to 3 different countries, then therefore, this choice of initiation date accounting versus settlement date accounting has to be done on a payment system-by-system basis. That's an accounting policy choice. So for this, they may say that so in my example, if they have payment made via 3 payment system, for this first one, they may say, I will apply the settlement date accounting. But for the other 2, they may say, I will apply the day when I have initiated the payment. That is very much permitted, because the standard post-amendment requires that this optional exemption, the choice can be made on a system-by-system basis. Now, as I already mentioned, this is effective from an IFRS perspective on 1st January 2026. Reporting period is starting 1st January 2026. And from an Ind AS perspective, likely that this will be for starting FY 26-27. And early application is permitted from an IFRS perspective. So, what is the key impact of the amendment? Now you can see entities who are currently using this date, who are currently recognizing or derecognizing, as the case may be, in our case, who are currently derecognizing the financial liability on payment initiation date, they are likely to get impacted because they cannot do the accounting on this date for derecognition unless all these 3 conditions are collectively met. If any of these conditions is not met, then this accounting will not apply. They need to necessarily do the derecognition accounting only on the date when the actual settlement happens and the money gets credited to the bank account of the recipient. Okay, that is why it is very important to understand. And we will see the impact assessment in the next slide. Now, before that, let us understand what is the logic, why this kind of amendment has been done. Let us see the next topic to understand why this amendment. And I will relate it to the first slide which we saw during the day, wherein we saw what is the generic requirement. So see here, why aspect of this accounting policy choice. So the choice is to the entity, the first choice is derecognize the trade payable on the settlement date, and by way of an exception, derecognize trade payable on the date of instruction to the bank. But this is a choice which you have to make. For each one of these, there is a reasoning why this requirement has been given. Let us first see the left-hand side of our slide, wherein what is the reasoning why the trade receivable or the financial liability, why the standard setters have clarified that it should be done on the settlement date. Because the principles which are there in the standard, they have utilized it. So say, if you see here, when this settlement date accounting is applied, that means the day when the foreign vendor receives the payment. When this settlement date accounting is applied to a financial liability, the extinguishment of the trade payable. If you remember, we said under IFRS 9, paragraph 3.3.1 says that you will derecognize the financial liability when it is extinguished. So the reasoning is that when you apply settlement date accounting, extinguishment of the trade payable in accordance with paragraph 3.3.1 will happen on the day when the foreign vendor, the recipient, receives the cash. Because that is the date, on the 3rd of April in our example, that is the date when the payer, the Indian company, has extinguished its obligation to the recipient. That is the first logic why the settlement date accounting is required by the standard setters. And as I said, this requirement is consistent with the requirement in IFRS 9, or for that matter under Ind AS 109, which states that the derecognition occurs when the debtor is legally released from its responsibility for the liability. And how that legal release will happen? Either by process of law or by the creditor. If the creditor gets paid, the legal liability no longer exists, and therefore the buyer in our example, the Indian company, will be legally released from its obligation to pay to the foreign vendor. So therefore, this view considers that the legal release for the Indian company occurs when the recipient's right to claim the cash from the Indian company comes to an end. And when the right will comes to an end when the counterparty, the supplier in Finland, actually receives the cash. This is the logic why the standard setters have said that you will derecognize trade payable on the settlement date. And this requirement or this guidance is consistent with the existing paragraph in para 3.3.1 of IFRS 9 or Ind AS 109. These paragraphs so what the standard setters have done, they've tried to clarify by using the existing provisions and laid out and provided a clarification what is the date when the derecognition should happen. Now, what about this? Why that option has been given? The option on meeting those three conditions have been given again for the very logical reasons. So you look at on the right hand side, when this accounting policy wherein the derecognition is allowed on meeting the three conditions on the date of initiation. So when this accounting policy is applied to a financial liability, so for example, the trade payable, then in this scenario, extinguishment is assumed to have occurred on the day the payer, the Indian company, has executed its cash remittance to transfer the cash. Why? Because this is consistent. This requirement that you derecognize on the payment instruction date is consistent with the requirement in IFRS 9 and 109, which states that the financial liability is extinguished when the debtor, the Indian company, discharges the liability by paying the creditor, the Finland company, normally with cash or some other financial asset or goods or service. Now in this case, because the debtor gets discharged by paying the creditor, initiating the payment on 31st of March. This view, when we say this view, considers that when we say the debtor pays the creditor, that payment to the creditors in this view occurs when the creditor, basically the Indian company, executes its payment to the Finland company. Okay. Consequently, the trade payable is derecognized and cash is also derecognized. Both from an Indian company perspective, if this view is taken, both the cash and the trade payable is derecognized on the date the buyer executes the remittance to the the foreign supplier. The reason is very obvious, because as we have seen, one of the conditions for this accounting policy choice was that the cash has gone out of the door, and there is no way that this cash can be used by the initiator, the Indian company, and therefore cash is also derecognized, and the liability is also derecognized on the day payment instruction goes to the bank, Indian bank. So this is what the logic is. And of course, as you may be aware, that under IAS 8 or under the Indian equivalent like Ind AS 8, paragraph 13 of this standard talks about that the accounting policy, whatever accounting policy you have selected, and we have seen that the accounting policy choice which is required to be selected is on a system by system basis. So if you have multiple systems through which automated payments are happening, then the choice has to be made at each system level. That must be applied consistently with similar transactions. Now, what is the impact of this? This amendment may have significant impact for certain type of customers. So what is the impact of this amendment? Let us see. 3 key areas of amendment. Now this, as I mentioned earlier, this amendment is expected to impact all those companies who are currently recognizing or derecognizing their liabilities on the payment initiation date. Because, as we have seen, this payment initiation date accounting for derecognition can happen if and only if the 3 conditions which we saw in the earlier slide, they are met. If any one of these is not met, then this accounting cannot be done. Okay? Therefore, everyone has to assess. That's where the significance of this amendment lies, that every entity need to assess the impact of this amendment on their own financial statement. Then they need to review the terms and conditions of the electronic payment system using which the payment is being made by the entity to assess what are the specific criteria for the exception, whether those specific criteria, the 3 criteria, are they considering these terms and conditions, are they met? Are they being met or not? If not met, you will not be able to do accounting on the payment initiation date. And also, accounting policy choice can be made on a system by system basis, and therefore the entity also need to determine which system they want to follow, which particular accounting policy. That is another piece which the entity on a go forward basis, once these amendments are effective, need to decide on that. And obviously, this is the most critical impact. How the new requirement is going to impact the financial reporting system and processes, say bank reconciliation. This also has a big impact. Let me explain why. So assume that the 3 conditions are not met, right? So in this case, if the 3 conditions are not met, the entity has initiated the payment on 31st of March, which is eventually credited on 3rd of April in the bank, in the foreign vendor's account. Now, from a bank reconciliation perspective, even if the money has been debited to your bank account, you cannot, because your trade payable still remains in the books. And though the bank credit has happened. So therefore, it will create an outage in your bank reconciliation. And also, there has to be a process to really understand what is the exact date on which the foreign vendor actually received the payment. Because going by the spirit of this standard, the actual recording of the entry of derecognition in the books of the Indian company will happen on the actual date when the foreign vendor receives the payment. So you got to also have a process to understand that each such payment made to the foreign vendor, in my example, what is the date when they have actually got the payment in their bank account, because that is precisely the date on which the Indian company will be able to derecognize their trade payables, or for that matter, any other financial liability. Here lies the impact of this particular amendment, and this is what a short summary of the amendment I wanted to highlight with all of you. I have given obviously the link of this YouTube channel as well as my LinkedIn profile. If you feel free to connect with me, and also I really encourage all of you, consider subscribing the channel if you think that the content of this channel is something which is helping and enriching your knowledge. Thank you very much. Bye for now, and we will meet in another video, another interesting topic which is of relevance. this time I think think that the next time we will talk about something on the, again, ESG framework, whereas I will try to give differentiation between scope 1, 2, 3 emissions, what these 3 emissions are all about. I will try to load a video regarding this, that what these 3 emissions are, how one need to differentiate between these 3, the various kind of scope of emissions which is being talked about in these days. So for now, thank you very much for your listening, and we will connect on the separate next video in some other, maybe next week. Thank you. Bye for now.